If you default on a loan and the bank seizes your property to recover the dues, here is something you need to know. Starting from 1st October, you will have no way of buying that property back, not directly and not through a relative either. The Reserve Bank of India has issued new rules closing exactly that loophole. Under the RBI's new framework, properties bank acquire from loan defaulters, officially termed specified non-financial assets, cannot be sold back to the borrower or anyone classified as a related party. This restriction remains in effect even if the property is later reclassified. Banks that already hold such properties have until September 2027 to fall in line. This isn't a standalone rule. It is the latest step in a reform going back over 2 decades. In 2002, a special act gave banks the power to seize a defaulter's property. In 2016, the Insolvency and Bankruptcy Code went further, barring defaulting company promoters from buying back their own businesses, but that safeguard never extended to seized property. In 2019, the RBI revised its entire framework for handling bad loans. And now, in 2026, that same no buyback principle from 2016 has finally been extended to property too, closing a gap that let defaulters find their way back to what they had lost through a relative and associate at the very auction meant to recover what they own. This applies only when a loan turns into a non-performing asset and the bank has taken over immovable property, a house, a shop, commercial land to recover what's owned. It doesn't cover agricultural land or farmland. Once a bank takes over the property, it can hold on it for maximum of 7 years, but within that period, it has to sell it through a public auction. The bank must revalue the property every 2 years and record its value at whichever is lower, the book value or the current market value based on independent assessments. The RBI's reasoning is straightforward. Banks aren't in the business of trading property, but recovering defaulted loan leaves them little choice. What these new rules are meant to prevent is defaulters gaming the system through loopholes that insolvency law closed years ago, but property law never did. For anyone with a secured loan, the message is simple. Default and the property you put up as a collateral could be gone for good with no way back in. With anyone with a secured loan, the message is simple. Default and the property you put up as collateral could be gone for good with no way back in.